Yeah, welcome everyone to the Basler AG Q2 earnings call. My name is Dietmar Ley. I'm the CEO of the company. With me today are Verena Filling, our investor relations manager, and Jürgen Marquardt. Jürgen is so kind hosting the meeting here for us today. Glad to have you with us. As you can see, I'm attending this meeting here from my vacation home office at the Baltic coast. So we have got very nice weather over here. So hope that doesn't impact the performance by any means. Yeah, so let's get started with the executive summary. So as you could already see from the Q1 numbers, the market environment for investment goods, especially in the robots and automation sector, is good. We just got yesterday the recent numbers, the most recent numbers from the German Machine Building Association as far as the robotics and automation market is concerned. So the VDMA is breaking up the numbers here and is providing specific numbers for vision components. And as you can see here, the numbers for the German machine vision industry, as far as the components are concerned, are up 17% in billings and 29% in bookings for the first 6 months of the year. So these are really good numbers, which we haven't seen in a while. Which is underlining that the investment goods market is in good and healthy condition. So the background of this growth is the high demand from certain verticals, especially the semiconductor industry, the electronics industry, and also the worldwide logistics sector is showing strong conditions and strong demand. From a local point of view, let me quickly here switch on my laser pointer. From the local point of view, we've seen the strongest momentum from the Asian markets, as usual, followed then this time by the North American markets and the European, Middle East, African markets. So what we certainly will be talking about later in the call is that the market conditions are also characterized by the global shortage of semiconductor components. So that shortage, if anything, is going to continue for quite a while. It has been already pretty tight over the last couple of months, and from what we are hearing from our suppliers, this situation isn't not going to change anytime soon. So that being said, let's have a look on the Basler performance for this first 6 months. And I'm very happy and proud to tell you about, let's say, record numbers here. So as you can see, our bookings went up by a stunning 65%, and billings were up 30%. So comparing this to the German industry references here, you see that Basler has been significantly growing market share and has been growing a lot faster than the industry as a whole, which is, I guess, due to the strategy that we have been following over the course of the years, the volume strategy that most of you know about, but also is due to the strong foothold that we have in the Chinese market, which has been a strong driver of our growth during the first 6 months of the year. So then here in the second bullet point, you see the earnings after tax are also up very strongly, so up 64% versus the last year, which is due to the high sales itself or themselves, due to the healthy gross margins that we were able to command, and also, last but not least, to the operational leverage. So all our facilities are fully loaded. So that means that the overhead costs are relatively low compared to previous years, and that contributes then to the strong earnings that we are showing here. So yeah, the production ramp up is also very steep. So ramp up or the growth is 35% in unit numbers year over year. So also something we are quite proud of. especially under those supply constraints that I was mentioning a moment ago. And also not to forget the COVID-19 circumstances. So our production is still completely separated from the rest of the company. So the people are really delivering here an outstanding job in doing what's possible to get the orders turned into revenue. Yeah, you saw it here, 65% bookings, 30% plus in billings. So that means a growing backlog of let's say unprocessed orders, which is due to the supply situation first and foremost, and that is then leading to extended lead times. So we are right now for the high runners at around 10 weeks of delivery time, so which is a lot longer than usual. So typically we have 2 to 3 weeks. So you see that this situation is really tightening. But yeah, it is what it is, and we are under the impression from our suppliers that we are going through that how to say supply crisis, you could name it, much better than other people, because we are commanding large volume with most of our suppliers. Therefore, we have a strong position with them, which means that so far we have been able to manage that supply chain pretty well so far. So we switch off here the laser pointer and then come to the next page. Let's shed a little bit light on the product highlights, the innovations that we have been showing and introducing to the market lately. So let's get started here with the first bullet point, the launch of 6 new high-resolution camera models. We call this series, we call it the Boost, the Basler Boost. So this is one of our latest product platforms, and we are continuing to add sensors to this with a special focus to high-res, high-performance applications in the markets like semicon, like electronics. So those cameras are delivering an awful lot of data, which need also a very capable interface in order to get them handed over to the image processing computer. So this interface is called CoreExpress. So up to 12 gigabytes of data can be transmitted here. So this is certainly, let's say, a very nice growth perspective for the future also, especially with the new sensors coming for the high-res applications. So then also something which might be interesting for most of you, we have signed a collaboration with Amazon Web Services in the area of embedded vision. So you know, Amazon Web Services is a cloud service provider, but also, let's say, completing their offering or extending their offering with, let's say, with image analysis functionality, especially artificial intelligence-based image analysis. And we have been working with Amazon Web Services over the last couple of quarters to put together an offering for customers consisting of both the Amazon Web Services software and some suitable hardware that makes it as easy as possible for the customers to transition from what might be might has been a PC architecture than to an embedded vision architecture, which is new in many regards. Then also third bullet point here, we have further added to our non-camera vision component portfolio. Together with CCS from Japan, we have developed a joint offering in the area of illumination. You can see that here down here in the lower right-hand corner. So Basler is providing, as usual, the camera, is also providing an illumination controller that you can see here, and CCS is then providing those illuminators that can look very different depending on the application that you want to solve. And yeah, we have been rewarded here with an Innovators Award lately, because we again made another contribution to our value proposition to make life easier for our customers. So first of all, it's very competitive from a pricing point of view, but it's also very easy to use with less cabling. You can steer the controllers from the Basler camera, You then need only one software development toolkit instead of two, so only the Basler toolkit, which is then a shorter time to market, less complexity for the developers. So we feel it's a great addition to the portfolio in order to make life easier for our customers' development teams. Okay, so then what else? Organization has been growing, but not so much. You see here 28 FTEs added since December 31st. That doesn't sound a lot, but I would like to go here. So the third bullet point right away. We are having approximately 100 open positions right now, and we have, let's say, decided on a hiring program for approximately 150 employees worldwide within the next 12 months. So that means also the organization itself is scaling and is adapting to the much larger volume of the business. The structure itself within the organization hasn't changed much. You see here a good third is working for sales and marketing or in sales and marketing functions. We have then a quarter working in operations, so production, procurement, logistics and such. And then 16% including all management in the administration side of the organization, and another quarter then in the R&D side, making up then or adding up then to 840 FTEs at the end of June. Yeah, some other highlights. So we were able to win here an award regarding the from Deloitte and BDO, a German auditor. So those companies are looking for, let's say, organizations in the market that have been that were differentiating themselves regarding strategy, regarding company culture, regarding, let's say, growth, regarding lean management and such. And we participated here for the second time and got awarded also with a second time in a row here with this award that we are quite proud of. Yeah, maybe even more important for us is, let's say, a certificate here that kind of refers to, let's say, work-life balance issues. So we just talked about the high operational workload in the organization. So it's really all-time high there. So the question is then, how do you make sure that your workforce, that the entire team remains healthy, and how can you support the departments and the individuals in managing their internal difficulties, that their personal difficulties maybe also. And here's a lot of activity going on. And this organization, so Beruf und Familie, it's actually the Hertie Foundation that is running this, has awarded us a couple of times over the last years and also this year again. So then one thing that Hardy certainly mentioned in previous calls, we are in the midst of transitioning over from the SAP R3 ERP system to the new SAP S4 HANA system. So we are here, as I mentioned, in the midst of the project. It's a real large project for us, as I guess for every company introducing a new ERP. So we are expecting this to finish during the first half year of next year. And then here on the lower right-hand side, you see a drawing of our building expansion at the Ahrensburg headquarters, giving space to another 350 people. You see down here a new bistro and the multi-purpose working area, co-working space and such. So that's very well in line with the timetable. So the raw building will be handed over end of September, and we hope to get the building completed by mid of next year. So as you can see, a lot going on here in the company. We are a big construction area at the moment, but very positively annotated. You see here also what the construction area looks like from a strategic point of view. As we have probably told you in previous calls, we are on the way to transition over from having been a camera manufacturer to becoming a full range provider of vision components, hard and software vision components. And you see here, we are on the trajectory to add both here the offering. So certainly based on the cameras, the cables, the lenses, processing, and there will be software offerings in the near future as well. And then here on the x-axis, you see then the vertical markets that we are addressing with the solid base in the factory automation space, medical life science being our second biggest market, traffic, intelligent traffic systems, logistics, fast-growing vertical, and retail is something especially for the embedded vision technology as it looks. So we are here in full swing to move up here the ladder, both in terms of additional verticals as well as also with new component categories. Yeah, then let's come to the financials of the first half year. So as mentioned in the beginning, the order momentum has really been strong, and you can see this here in the yellow bars that show an unseen performance over the last couple of quarters. So comparing here to last year's Q2, 39 million, then almost same level than in Q3, and then 53 in Q4, 67 in Q1, and then a stunning 85 in Q2 of this year alone. And also, let's say the billings have grown significantly here from 41 to 55 to 61. So Q2 bookings year over year, 118% up. Half year one bookings up 65%. So that's really something. And we are very happy and proud about how the team has managed so far to manage this order volume. Yeah, let's have a look at the regional split. I mentioned already that the China market has been growing and was the first and foremost source for the growth in revenue and order entry. We can see that here Asia is now accounting for 57% of global revenue. So China is more than 50% of that. So we have then EMEA with 28% of global revenue, Americas with 15% of global revenue. We need to admit that, let's say, some of the American customers order in Europe from within Europe. So these numbers are a little bit distorted and possibly are more closer than it looks here at the chart. And we see here, yeah, the total order volume 115.2 million for the first 6 months. Yeah, let's then move over to the gross profit in absolute numbers and also to the gross profit margin. We can see that the gross profit margin has been staying here on a healthy level, so 54.3%, so which is by and large the same like in the Q1 of this year. As to the growing revenue, the gross profit in absolute numbers has been growing as well from almost 30 million euro to almost 33 million euro. So we expect this number to go down a little bit as to the supply chain challenges that we have. So we see here more often that we need to pay extra prices in order to get hold of the material that we need to manage the growth. So what we also see is that the operating expenses due to the new hiring and some investments is going to climb. So don't be overly surprised if this number is deteriorating a little bit. But we are coming here from a very healthy level, and we will stay in very healthy areas here. So yeah, that's the development of the gross profit. If we then look at the earnings before tax, we can see here last year 6.6 million at a EBT margin of 14.6% for the Q2. We are seeing now here 10.8 million in absolute numbers, earnings before tax, and the margin is 17.8%. So this is mostly due to the scaling, to the leverage, to the operational leverage. The organization itself has not significantly grown as we saw before. So that means we are more or less handling the larger business volume with similar size of organization, and that has certainly, let's say, contributed massively to that jump in the earnings before tax margin and absolute numbers. Yeah, then the profit and loss statement itself. We see here the order entry 92.3 versus 152.4, so up 65%. We mentioned that. Sales we looked at as well, plus 30%. So the gross profit is 1.3 percentage points higher. EBITDA is 50% higher, EBIT 60% higher, and EBT then 63% higher, which made the EBT margin grow by 3.7 percentage points. So the net income also 64% higher, which doesn't surprisingly lead then to a 64% growth in earnings per share. So real nice numbers that we have here today. If we look at the cash flow, also good news to report here. We saw here in last year's Q2, we saw a good operational cash flow, 13.3 million. We saw, due to, let's say, outstanding M&A final payments, we saw a relatively high cash flow of investments of minus 9.7. That looked entirely different this time. So we had only 3.5 cash flow from investments, which is in line with what we normally have by and large. But we had another very strong operational quarter with very strong operational cash flows, so that the free cash flow was at 9.6 million euro for the second quarter. Adding the 1 million here from the first quarter ends up then with 10.6 million euro free cash flow for the first 6 months. So very nice results here too. Yeah, so let's have a look at the statement here, at the cash flow statement. We see that the cash flow by the beginning of the period was 47.9. Then we got a very nice 19.7 operating cash flow for the first 6 months, minus the 9.1 for the investments, makes the 10.6 that I already mentioned, minus cash flow from financing, means then 45.7 million euro cash at the end of the period. Liabilities to banks slightly lower than a year ago. Cash and cash equivalents also slightly lower than a year ago. So operative net cash 22.5 million, almost exactly the same like last year, despite the large growth in orders, accounts receivables, and such. So to me, this looks like a pretty healthy situation here that we can show to you here. So then let's have a look at the share price. So by the end of the quarter, of the second quarter, we ended at a share price of 104.40 euro for the share. After the message today to the markets, share price climbed to above 120. So right now, if I look here at my smartphone, it's at 123.60 at this point in time. So that means that the market cap, which used to be 1.04 billion by the end of June, is now more closer to 1.24 billion today. So treasury shares, as you may know, we have a share buyback program running, and we reached the threshold of 5% voting rights of own shares on July 19th of this year. So overall here, also if we compare it here to the TecDAX, it's a very positive development that we were able to demonstrate here. Yeah, then coming to the outlook already. So we feel that we are in a strong momentum still here in the beginning of half year 2. So the markets are showing strong demand. What we, let's say, are beginning to observe is that our customers are, let's say, getting a little bit nervous regarding the question whether they may get their goods from their suppliers. So this is also true for us. We see here that the timetable, that the time horizon for the new orders is extending towards the end of the year, or even in the beginning, towards the beginning of next year. So this behavior and those extending periods of the orders placed shows that customers are getting concerned about whether they may get their goods, and so they want to get into the line. So that means that, let's say, some of the recent order entry that we have seen might be artificial and is not, say, based on, let's say, solid normal numbers, but it's based on the concern coming from the semiconductor supply shortages. So what we are expecting from the next couple of months, we have still high order entries to expect from the semiconductor electronics sector. So maybe not at the extremely high level of May and June, because we have a certain seasonality here, and in the third quarter, typically the demand is a little bit weaker than in the first and the second quarter before it again starts to climb towards the end of the year. But what we see also is that the how should I say, the classical business with factory automation customers, or also medical customers, expected, let's say, to come to full fruition only now in the second half of the year and also beginning of next year, because those industries were later in the recovery than semiconductor electronics. So we also see an ongoing strong business with our logistics customers. We know that online business is growing sharply. So also here, we have to assume that this business is, on the demand situation here, is continuing to stay very healthy and strong. Yeah, as far as the shortage in the semiconductor sector is concerned, this is the single biggest risk for our growth velocity, or because depending on, let's say, whether or not we are really getting the material that was promised to us, and whether we are getting it at the promised quantities, let's say, this may result in a bottleneck for our production output. And this is also the reason why we did not increase guidance, as we see in a moment, because we see this really, this risk has a certain probability to materialize. So far, we have been doing very well, but this is not a guarantee that it stays this way. So we wanted to make you aware of that. I think we guess you have heard that from many other companies too. But this risk is still existing. What we're also expecting is that we need to buy the material to manage the growth, which is above our expectations. So we also need more material than expected. So we anticipate that the material to satisfy those extra demands will become more costly than usual, because, let's say, the quantities that we have forecasted are below what we now really need. That means that we need to go to spot markets as well, and the materials that you buy from the spot markets are always more expensive than the normal materials that you get directly from the suppliers. So that may mean that the gross margin, let's say, deteriorates by and large by 2%. Yeah, so that brings me then to the last page already, to the guidance. So we have very nice and healthy half-year 1 results. We have a strong order momentum, but we also have the described and ongoing supply shortages, which makes us to maintain our guidance for now. we want to wait here for another quarter before we review the guidance the next time. So that means that we keep our guidance for now, meaning that revenues are expected to come in within a corridor of 205 to 225 million euro at an EBT margin of 13 to 15.5%. So unchanged guidance for this year as far as it looks right now. And I think once we are in November and have passed the third quarter, then we are certainly having a much better transparency for the remainder of the year, and can give you then a quite solid feedback of whether we are able to increase the guidance or whether we need to maintain it within the current corridor. Yeah, that brings me then to the midterm plan. So you know this chart since quite some time. And so as you can see it here in the headline, we are in the midst of reworking our midterm plan, our 4-year plan, in the light of the recent growth. So I guess you agree that the 250 million revenue goal for 2023 is looking quite conservative at this point in time. So we have been a little bit outperformed here by reality. So we need to readjust this, and this will be done within the third quarter, so that you can expect an updated midterm plan during the Q3 reporting. So as far as the profitability is concerned, to 12% EBT margin in the normal case, the 15% compound annual growth rate, and also the 70% cash conversion rate. There's high probability that this remains unchanged. But in such a stellar year like today, like this year, where we have a much stronger growth, top line growth than the 15% that we see here, that needs to be reflected in the midterm plan. So that will be reworked and presented to you then within the course of November. Yeah, so that's it for today. I will be closing the presentation, and I'm happy then to be available for you and in order to answer your questions.